Investment strategy. The Fed wants inflation. What's next and how to position for it? The most consequential central bank in the world, the US Federal Reserve, announced a shift towards average inflation targeting, whereby it will allow inflation to overshoot its 2% target to make up for periods when inflation has run too low. This represents a major change in the Fed's monetary policy strategy, and in our view means that the Fed funds rate will stay at its near zero level for up to the next 5 years. After unleashing an unprecedented amount of stimulus against the COVID-19 crisis this year, the Fed has by now engineered a perfect V-shaped market recovery that was only a few months ago believed to be highly unlikely. And this tidal support of financial asset prices and wealth effect have contributed significantly to supporting consumer spending and confidence and the momentum of the ongoing recovery. Not to forget, Biden continues to lead in the polls for the upcoming US presidential election, and prediction markets are at present reflecting a Democratic sweep to be the most likely election outcome. The Democratic Party's agenda to implement significant fiscal spending on healthcare, the environment, and importantly, infrastructure, will potentially form another key tailwind for inflation. Bottom line, in our view, the bigger investment implication of rising inflation relates to the equity allocation in portfolios. Granted, growth is likely to be scarce in this new economic cycle ahead, and hence the focus on maintaining long-term core positions in growth sectors exposed to structural trends such as 5G, e-commerce, IoT, the Internet of Things, and the cloud will form an indispensable mainstay of investment returns. But given the dramatic year-to-date outperformance of growth sectors versus cyclical or value sectors such as energy, commodities, and industrials, which remain attractively priced and are poised to benefit alongside rising inflation and recovery, we believe that it's now appropriate to rebalance from much larger technology and healthcare positions, given the sharp year-to-date rally, into selective cyclical and value names. This will further diversify portfolio exposure across a wider range of drivers of performance and contribute to buttressing portfolio volatility ahead.